Today is Monday, October 6th, and this is the ADM Investor Services weekly market kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMS Senior Ag Analyst, and JP Steiner, ADMS Associate Economist. Starting with the financials this morning, JP, why don't we start today with one of the items that's currently in the headlines? What are the possible implications of the U.S. government shutdown?
There are several implications regarding the government shutdown, with the more serious ones surrounding the extent to how long the shutdown lasts. Starting with the obvious, government data releases will be delayed. This has already been seen with last Friday's non-farm payrolls report for September getting delayed, causing markets to rely on private figures instead. Those private figures last week, Challenger job cut data showed a drop in the number of job cuts, while ADP non-farm private payrolls data showed the private sector lost 30,000 jobs in September. Regardless of the data, the absence of September's official non-farm payrolls figures means that unless there is a resolution to the shutdown before the Fed's meeting later this month, the Fed will be heading into the meeting with no read on what the labor market did in September and will also not see revisions to previous month's data. Labor data has been crucial for the Fed this year, as the downturn in the labor market has been responsible for the reduction in interest rates despite a stronger inflationary environment. Despite the Fed flying blind, the bank is still expected to cut rates later this month. Fed fund futures are pricing in nearly a 95% chance the Fed will cut rates, while odds of a December cut are just above 83%. The shutdown also raises the risk that data for relevant economic figures could suffer from reduced quality, particularly with the inflation report, as the employees that the government relies on to collect the data are furloughed. This could raise the risk that markets will question the quality of the data, as workers from the government are not able to get out in the field and gather relevant price data for the month. While past shutdowns have showed that data quality was not significantly compromised, longer shutdowns can reduce response rates and survey completeness. Even if the data is eventually released, timing mismatches could occur and distort month-over-month comparisons, resulting in notable revisions to prior data. So while the shutdown is not the end of the world, especially as markets and the Fed largely understand that the labor market has been subdued, the extent of the shutdown could cause problems for the Fed and lead them to operate without the necessary data.
Let's flip to something else here, JP. We've seen the gold market continue to rise. Is the gold rally going to lose steam here anywhere?
Yeah, gold's been on a historic rally, and today it broke above the 3,900 level for the first time ever, even despite a stronger dollar. And since it seems that every week we hear headlines that gold has reached another record high, this has led some investors to question whether or not the yellow metal has much further room to run. Personally, I still think gold does have a lot more room to run, given that it is receiving underlying support from strong central bank purchasing, strong retail investment, and is also getting a nice tailwind from expected interest rate cuts out of the Fed. Starting with the retail investment side, global gold ETFs saw their third consecutive month of inflows in August. That's per recent data from the World Gold Council. Their assets under management rose to another month-end peak, and collective holdings continue to rebound, rising 53 trillion to 3,692 trillion. That's the highest month-end value since July 2022, and just 6% below the record of 3,929 tons, which was recorded for the first week of November 2020. In 2024, central banks added over 1,000 tons of gold, marking the third largest annual increase on record. In 2025, purchases have continued. Kazakhstan, China, Turkey, Poland, and the Czech Republic have been among the most active buyers in the central bank space. Despite gold's price rising nearly 50% year to date, central banks' continued buying has showed that they are price insensitive to gold, signaling a strategic commitment to gold. Central bank purchases have also created a structural price floor, supporting gold even during periods of investor uncertainty. Historically, around every 100 tons of central bank buying contributes to roughly a 2% increase in gold prices. Additionally, the World Gold Council reports that 95% of surveyed central banks expect their gold reserves to increase over the next 12 months, reinforcing the bullish sentiment. Countries like China and Poland are reducing reliance on the US dollar by increasing their gold holdings as well. On the interest rate front, expectations that the Fed are going to cut rates continue to add further momentum as the non yielding metal benefits in a lower interest rate environment. So, while the historic rally has raised questions about the extent to which gold can keep climbing, I think the underlying fundamentals are providing gold with a solid floor, allowing the rally to continue further.
Thanks, JP. Mark, highly unlikely that we'll see any numbers from the USDA this week. How do traders view the lack of news, and what are your expectations for production and stocks?
Yeah, Kurt, with the warm, dry finish, we had this growing season across much of the central Midwest. We saw a pretty steady drop in crop ratings since peaking in early part of July. That said, I'm guessing we're just going to continue to see a little bit of a reduction in this year's corn and soybean yields like we saw in September. In corn, I'm going with an average yield of 184. That's down from USDA forecast in September of 186.7. Well, still a record large. That is actually down now almost 5 bushels an acre from the USDA forecast of 188.8, that in August. So this 184 yield, that would leave U.S. production at 16,570,000,000 bushels. That's down 244 million from the USDA forecast last month. Ending stocks from the 24-25 marketing year at just over 1.5 billion bushels. That was above expectations. That due to higher production from last year's crop and weak domestic demand. I think that weak domestic demand carries over into the 25-26 marketing year as well. So I've got new crop usage at just over 15.9 billion bushels, down 150 million from the USDA forecast. That leaves ending stocks at a healthy 2.2 billion bushels. In beans, I look for a slight drop in yield to 53.3 bushels an acre, still a record high here as well, and that's supported by the record high pod counts. But I do think these pod weights will be down a little bit, again, due to this lower or poor finishing weather. That would leave production, basis my yield forecast at 4.28 billion. That's down 21 million from the USDA in September. Without a trade deal with China, look for the USDA to whittle away at that export forecast. I think it's going to be down another 35 million bushels to 1.65 billion. That would be at a 15-year low on the exports. So with the lower production, lower usage, I've got ending stocks holding steady at 300 million bushels. In wheat, all wheat production last week came out at 1.985 billion, 60 million above trade expectations. So with minimal changes to the demand side of the equation, I've got ending stocks at 905 million bushels, a 6-year high.
Mark, without the routine reports and the data that's contained in them, what will drive prices across the ag space this week? Will we turn to private estimates, reports, things like that?
Yeah, we're still reporting our estimates to the Reuters and Bloombergs of the world, and they're still going to report expectations as if the USDA report was still going to go on. So I think that will help drive prices. But there's a lot of other things too. That could still drive market volatility. Harvest is in full swing. I think corn is probably sitting at about 30 to 32% done. Beans approaching 40%. I would expect domestic basis levels to start to weaken as storage levels tighten up here a little bit more. That will also in turn keep these spreads at pretty wide levels. Weather-wise, we're going to see a little bit of rain, it looks like, early part of this week, which could cause some slight slowdown to harvest. But other than that, temperatures look to remain seasonably warm, really going right up into the middle part of this month. And also, you've got social media posts from President Trump last week stating that China's lack of U.S. purchases will be a major topic of discussion later this month when hopefully they meet at a summit here in South Korea. Yeah, his tweets, his social media posts last week helped drive prices back above that $10 level. So right now, to me, it would appear that for China to turn back to U.S. soybean purchases, it would require the Trump administration to drop this 20% fentanyl tariff, which could also hinge on China making $1 billion investment into Chinese-owned factories here in the U.S. So a lot of moving parts right now. And meanwhile, the Supreme Court is expected to hear arguments next month on whether the Trump administration's use of tariffs were actually legal in the first place. So all this going on while South America, they're planting their crop as well. And right now, expectation is for this monsoonal rains to start bringing some relief to these dry areas down there about the middle part of this month.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.